Good Saturday, everyone. Welcome to the show. I'm glad to have you guys here now. There's an awful lot going on in the world right now, and one of the biggest topics that's going on right now is these trade negotiations between China and the United States and the tariffs that have actually went in place. We're going to talk about that. We're going to talk about a whole lot more. We're going to talk about Bitcoin, and we're going to get started right here by opening up the charts. First thing we're going to take a look at is at the Bitcoin price. Well, guess what? It's up big time. It's almost $7,000. Now, it went up. It just about touched $7,000 and then it drew back. I guess that $7,000 mark, it's you have to understand in all the markets there's psychological barriers. And so 7,000 evidently is a little bit of a psychological barrier. It'll probably break through it later, but I see this as a little bit of a premature breakout in the market. I wasn't expecting this breakout to happen for another couple more months. I thought we'd stay in the accumulation phase for a little bit longer before Bitcoin would start to break out to the high side, and this is a little bit premature as far as I'm concerned, But anyway, regardless of that, it's doing it, So let's take a look now at what's happening with trade, and Donald Trump and the trade tariffs and everything. We'll read a few of these articles. It says, China and the United States to hold more trade talks as Trump ratchets up the tariff threat. It says U.S.-China. This one here says U.S.-China trade dispute continues with no sign of resolution. Yeah, both sides are starting to think the same thing, think the same way. China's thinking the United States has got more to lose, and the United States is thinking that China's got more to lose. And when you get a situation like that, generally, a lot of times, people will dig their heels in, So I don't expect a resolution to this thing overnight. Certainly not overnight. Now, how will the markets respond to this come Monday morning? This is what I'm very interested in, because now it's starting to sink in, the ramifications. We haven't had this kind of a trade war going on since going all the way back to around 1929 with the Smoot-Hawley tariffs that were put in place, and that's one of the things. Well, in 1929 we had a stock market that was over leveraged. There was an awful lot of margin debt in the stock market in 1929, and people had the feeling that it was going to go higher and higher forever. Honest to gosh, they really did. They thought the stock market would never collapse. And we had a Teflon stock market, just like we have today. And people think it'll never collapse. And we had the tariff situation, just the same as today. And so we got all these articles. Tariff is a big story in here in the news this weekend. It says, here's why Trump's trade war with China is a disaster for everyone. And everyone else's economy, too. It says Trump's tariffs are a new tax on Americans. It's going to make inflation go up. This one's interesting from The Guardian. It says, could doomsday be nearing as United States and China trade war heats up? And they show a picture of that guy that... I can't think. There was a movie years ago where a guy got on top of a nuke and he rode it all the way down to the ground. He went yeehaw! And he was waving his hat up above his head. They got the picture of that on there. I'll just go to that article real quick. I want to take a look at that picture real quick. There he is, Slim Pickens. Rides the doomsday machine. You can go on YouTube and you can find that. Put in Slim Pickens and you can watch him a clip from the movie. It's pretty good, pretty interesting. Anyway, now in other news, Italy is in a a recession has been declared in Italy, and it says it could trigger a $2 trillion financial crisis that threatens the Eurozone itself. And it shows a picture of a ship listing with an Italian flag on it. The sinking Italian economy. You know, they've been propping the this is from Business Insider, by the way. They've been propping the Italian economy up by buying their bonds. But, you know, how long can they continue with this? It says Italy has entered a perma-recession and there's no obvious way out. The European Union rules prevent the kind of government deficit spending that might grow the economy. At the same time, Italy's debt-to-GDP loan has reached heights not seen since World War II. There is now a growing risk of systematic financial crisis. The scale of such a collapse would be a magnitude greater than the Greek debt crisis of 2015 and thus harder to contain. Well, I'm going to take this one step further. This is not going to be harder to contain. This is going to be impossible to contain. And this is why they're trying to prop Italy up by buying Italian bonds, which are going to be totally worthless, these bonds. It says, the problem itself illustrates the contradictory rules of the European Union and the European Central Bank, which prevent countries from investing in growth and make it impossible to leave the Eurozone without triggering the crisis that they seek to avoid. And so, it's one of those situations where damned if you do, damned if you don't. Now, if that wasn't enough, you know, we got Deutsche Bank, German bank. It's on the ropes. I did an article, I think I said it was on the rocks, but it's the same idea. They have no general plan at this point. They had a plan before. The plan wasn't working. The plan was basically chop, chop, chop. Chop employees, get rid of, cut workers, cut expenses and everything else. But that was just making the bank grow smaller, you know. And the bank is, it's fully integrated into the system. It's one of the too big to fail banks. It says Deutsche Bank is in rough shape and its leadership has gone silent on their plans for the future. First quarter results from Germany's largest bank on Friday showed that revenue is falling faster than costs. There you go. Now somebody's out there buying Deutsche Bank's shares in Deutsche Bank, buying Deutsche Bank stock. The thing is they're propping it up and they're keeping it up above 7% or €7 per share. You know, and how long can they do that with this failing institution? Well, I think it's another move to kick the can down the road, and that seems like all we're doing lately is kicking the can down the road on all these issues within the financial system. But there's going to come a point where there's no road to kick the can anymore. Now let's take a look at this article. Fang, which is a giant company in China, it's a giant real estate company, I guess, Fang.com. They have reported a slow year for Chinese real estate, and the Chinese stocks have tumbled 5%. Shares in Fang Holdings Limited tumbled more than 5% midday Friday to 1.52% per share. Now, here's the thing. The Beijing company, which operates online, has an online real estate business. And this is why, when I spotted this article this afternoon, I looked at that as a barometer of the Chinese real estate. This is basically, I saw this as kind of being a barometer. Because, you know, if you go through the news media in China, they always make everything rosy. You know, everything's better than what it actually is. But this is kind of a barometer here, and they give you some real numbers here of what's going on within the Chinese real estate. It says the Beijing company, which operates online real estate businesses, said in a statement today that its revenue in 3 months through December declined 27% year over year. Well, you know, that sounds just about right. That's just about how the Chinese real estate is moving right now. 27% down this year. It says their net loss was $48.2 million. or 11 cents per share, in contrast to the net income of $20.6 million in the same period of 2017. So it's slowing down. What's happening is the Chinese real estate, I would say that decline sounds just about right. Probably about 27% down this year from what their sales were for new homes and stuff like that. So all of the real estate markets around the world, in Canada, in Australia, in China, in London, and in the United States, they're all undergoing a slowdown at the same time. But the slowdown hasn't reached a point yet where it's like big front page news. It's just in the start of the decline. It's when you're at the top of the curve and you start to go down that hill. You know what I mean? That's where we're at right now with all of this. So they're worried. These companies are worried. Anyway, there's an awful lot going on. The Brexit hasn't went away yet. We still have that to worry about. They're only delayed it for 6 months, and we're heading toward that wall, and they're not doing anything, really. They're taking this time, and they're basically wasting it. I guess waiting for that 6 months to run out, and then they'll deal with it later, They've been given a reprieve, basically a 6-month reprieve. Thank you guys for listening to this report on this Saturday report on some of the issues that are going on within the financial system. And we'll catch you guys very soon, probably Monday morning, and I'll probably sometime early next week, Monday, Tuesday, or Wednesday, do another show that's added to the market report. So thank you guys. Of course, I'll be there Monday for the market report. Thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Oh, and give me a thumbs up. Bye-bye, guys.